The next keynote speaker is, well, actually I don't think he actually needs an introduction. He's the very distinguished professor in investment management. No introduction needed. This is Malcolm Baker. Please give him an applause.
Not checking my messages here. I think I'm just going to figure out the timer since there isn't a clock. And I think that I'm the only person standing in between you and the gala dinner, which is an uncomfortable position to be in. But thank you very much for having me. It's really an honor to be here. It's incredibly exciting. This morning, I got to see Dennis ring the gong to start the exchange trading today. And I'm happy to report that the AEX index is up 42 basis points, which I'm going to attribute entirely to Dennis. So if you can just start all future days of trading, that would be great. So this talk builds on papers with a couple of my co-authors here, and most notably Jeff Wergler, but a couple of others as well. It's not the most subtle idea in the sense that the distance between the assumptions and the conclusions is relatively short. You like these ones where it's like very hard to see. I started with these very simple assumptions and got all the way to this amazing conclusion. No, this is going to be a little bit different from that. They're relatively close together. And I'm hoping that you'll forgive me in the sense that you'll judge it more on the ratio of the number of implications to the number of assumptions instead. So maybe that's what I'll strive for. And the idea starts really from two facts that I think you're pretty familiar with, and they're about how risk gets compensated in capital markets. So it's going to start from kind of a asset pricing starting point or mispricing, and think about what some of the conclusions are for corporate finance, and I'll kind of go to a relatively wide number of implications. But if we think about how risk gets priced in capital markets, I want to draw a distinction between the risk across asset classes, where it looks like risk really is compensated, or investors have demanded a fairly high return historically for bearing market risk. So if I look at kind of the comparison between T-bill returns and the stock market taken as a whole, there's a pretty big spread there. And that's what we think of as kind of the equity premium puzzle. If anything, that spread between the return on stocks and T-bills is difficult to justify with standard models of utility. And so, if anything, it looks like risk is quite compensated. If you want to think about the stock market here, the risk that I'm thinking of is the beta risk or the systematic risk. And in this context, it's very simple. If I'm thinking about stocks versus T-bills, stocks have a beta of 1, T-bills 0. And there's big compensation for bearing that beta risk. And yet at the same time, if we look at within the stock market, that same systematic risk, and we can reliably find portfolios that differ in terms of not just their ex-ante beta, but their realized beta by meaningful amounts, that same beta risk within the stock market looks very flat. And in fact, this is somewhat cherry-picked, but within the last 45 years, this is kind of where the traditional CRSP sample starts. You can start estimating betas in the mid-1960s. It's actually been inverted. So you kind of have this cross-asset class pricing of risk of 5.2%, but then within the equity market pricing of minus 1.3% over a relatively long history. And this seems anomalous. If we look over the full CRSP sample, there is at least an upward sloping security market line. So CAPM beta is associated with return, but it's still quite flat in comparison with the kind of cross asset class return. So spread here between the two of still more than 5%. Okay, so what are the two facts you already know? There's the equity premium puzzle, and I'm going to say that the salient beta risk across asset classes is compensated. At least in the sense of we use historical returns as some sense for what investors demanded, it's been fairly compensated, if not overcompensated in terms of risk. And then the second piece is what I'm going to label the risk anomaly, is that the more subtle, and this is the beta risk within asset classes, appears to be relatively neglected. And this is obviously not new. I'm saying these are facts that you kind of already know. What have I done? I pulled a fast one here by throwing in a bunch of loaded and behavioral words like salient and subtle and anomaly and all of that stuff. So I'm just trying to get that in quickly without you noticing, but I can see a few people might have already noticed. And what of course I'm going to say here is that asset pricing has gone in two distinct directions with this evidence that we've all been chewing on for a long time. And one strand says, this isn't saying this market isn't inefficient, it's just that we don't have the right model of risk when we think that CAPM is an imperfect model, and really we need to find these subtler notions of risk. And in fact, maybe goes to a more extreme view, says anything that predicts returns, that must be risk. And anything that doesn't predict returns here, beta risk, must not be risk. And so that's almost a tautology, but that's one direction. And then another direction, I think, looks at this evidence and other evidence and says that through a combination of institutional and maybe behavioral biases, along with the limits to arbitrage, we get mispricing in the capital markets. And so behavioral finance, in some sense, is going to replace the fully rational and frictionless models that we're developing in more elaborate ways in the first bullet. Okay, so obviously, if I had the answer as to which of these was the correct point of view, it would be an asset pricing paper, and it's more of a corporate one. I think, though, it's at least reasonable to say that both of these have a defensible element to them. And this talk is going to take the second point of view more as a starting point. In the tradition of Jeremy has a nice paper from 1996. It says, what if we're in this world of inefficient markets and efficient firms? How would you optimally respond to mispricing? And the difference between this paper and that one is that I'm focused more on the idea of risk neglect, the fact that this thing that might actually be risk is not priced, as opposed to thinking more about things like the value premium and what if that's mispricing, what does that mean for companies? So the things that do predict returns. So the idea is a simple one, as I said, is we're just going to suppose that investors neglect risk within the equity market, so they're still getting things right across asset classes. And so they're overvaluing high-risk stocks and undervaluing low-risk ones. That's by the definition of risk neglect in some sense, and that's what one interpretation, at least, of the flat security market line. Okay, so what does that mean? If I'm sitting there with very low leverage and low asset risk, I'm going to think that my equity is significantly undervalued. And it's going to be appealing for that reason alone. Forget about the other motivations like taxes and cost of financial distress. It's going to be appealing for that reason alone to replace equity with debt. I'm replacing something that's undervalued with something that's fairly valued. And I'm also increasing the risk then of the remaining equity. So I'm getting that to be more highly valued as well. So I'm going to have a lower cost of capital. And this, if there is a more subtle point in here, and it wasn't initially clear to me, at least thinking about this, I was thinking, well, this is going to be like taxes. It's always going to push me to want to lever up more, make my equity more and more risky. Well, that's not the case. We'll actually get to an interior optimum here. I don't want to go all the way to 100% debt, because then I'll actually forego an opportunity to place high-risk equity in this location where it's overvalued. And so there's going to be an interior optimum, absent any tax benefits or cost of financial distress. We'll get kind of a trade-off here of these two effects. At very high levels of leverage, what I'm doing is my equity is then overvalued. It doesn't look as good to replace it. And in fact, I start shifting shifting risk over into debt and away from equity. And as a result, that's going to be inefficient in terms of locating risk where it's appreciated the most. Okay, so relatively simple story, and I'm going to, in the interest of time, try to get through it as quickly as possible. But the point that I'm hoping to get to fairly quickly, although it will take me a little time to get there, is that this simple idea is at least consistent with a range of facts about corporate leverage, and maybe even going beyond that to things like private equity and venture capital. And bank capital regulation is another area that we thought about. And if you want just sort of a preview, one of the, well, I don't know whether it's a puzzle or not, but an observation is that financial firms tend to run at very high leverage, and some industrial firms seem to have very low leverage and excess cash. And while I'm not saying this is going to explain all of that, it has this nice feature of being able to simultaneously get that kind of under one umbrella because of differences in underlying asset risk. A bank starts off with assets that on an unlevered basis look a lot like debt. They're just loans. And industrial firms, on the other hand, start with betas at 1, and some of them significantly higher. So that's the idea. And the plan here is these two assumptions. Again, like I said, there isn't a lot of distance between the assumptions and the conclusions, and so I'll spend some time trying to justify why I think that it's a risk anomaly within the equity markets is a plausible starting point. And then the important thing also is that this is an integrated risk anomaly. Modigliani-Miller holds as long as you have integrated markets. They don't have to be fully rational markets. They just have to have consistent pricing across debt and equity. And so I need to convince you, and that's kind of this cross-asset class versus within asset class piece, that there isn't one single risk anomaly that will kind of price all securities at once. Okay. With those two assumptions, it's relatively straightforward to get to some of those conclusions I described. Take a first-order condition, think about the optimal location of risk, and then I'll kind of use two anecdotes to reinforce this, and then fairly broad brush connect it to a bunch of facts. All right. So the risk anomaly is the key starting point. That's a very old fact, and I'm just going to show you really the data as the more recent history of the data, which I think is pretty powerful. I've kind of already shown you the punchline. But the important things to say is that beta actually is a pretty good way of sorting stocks and managing risk. In fact, I think that if you are an investment manager and you're looking at risk models, if you had to choose just one firm characteristic, I think you would choose beta or something like it to form something that was a proxy for beta if you wanted to get to low-risk portfolios. So this is an old fact. The basic way I'm going to write this down, and this will become briefly important, is that the security market line is too flat in the sense that we would normally, if things were working properly, have something like the CAPM over here, but instead we have this gamma term which is less than 0. And what that means is that the high beta firms have lower average returns and the low beta firms have higher average returns, and so a gamma less than 0 is going to do that. If the gamma were equal in magnitude to the risk premium, we'd have something completely flat, which is what the recent history looks like. Okay, and so here's kind of the data. If we form, these are sort of Fama-French style groups by trailing beta, break it up into 3 of low risk. Well, again, like I said, this is a pretty useful way of finding low-risk portfolios. The low beta group gets you to a portfolio volatility of 12.5%. These are just the monthly returns just shown here to show you how the noise increases as I go from low beta trailing to medium to high. So one possibility is that the beta just doesn't tell us anything. No, it tells us a lot in terms of risk. I can get to portfolios that are half as risky by paying attention to beta. If you don't like volatility, you can look at drawdowns. That's a kind of a popular industry statistic. And what we're seeing here is like from the peak, how much could you have lost in your low beta portfolio? And the answer is around 40%. So far from risk-free, these are still equities. But if I go to medium and high, then my drawdowns go up to almost double again, 73%. And if you look at when they happen, they're happening during the periods where I would think you would want to ensure, say, your employment status or the other aspects of your portfolio. These are periods like the early 70s and, of course, the financial crisis in 2000, 2001. So it's doing its job. Beta, you can spread beta by 0.7 in terms of realized betas. And then the question is, how does it look in terms of returns? And the answer is, this is making it overly dramatic because I'm showing you buy and hold returns here. But this is the high-risk portfolio now going in reverse order. That has an average return of 9.6%. It's 10.5 and 10.7 over this period since the late 1960s. So it kind of goes exactly in the opposite direction, and on a compound basis, pretty dramatic differences in terms of the value of $1 invested in 1968. You can find periods like this where there's a pretty dramatic difference. Of course, the buy and hold returns are going to benefit both from the higher average returns as well as the lower volatility to compound to higher values. Okay, so what's the response? And again, maybe this is the wrong measure of risk, and the CAPM is a simple model. There's lots of things you might worry about hedging other than the market return. But I don't think it's easy to come up with explanations for why risk would go the other way, or that low beta stocks aren't really less risky by any number of measures. And in particular, you can do this within industries as well as across industries. So it's not just like utilities did well. Within utilities, the lower risk stocks, there just wasn't a risk premium within industries. And you could also say, well, look, this isn't a very very strong result, and in fact, the t-statistic is not overwhelming. There's a lot of noise in this. It doesn't make for kind of a great arbitrage strategy, although some have proposed it, and it's not bad. It's just not going to be clearly better than something like value versus growth. You could also say, look, this is one of the true out-of-sample tests that we have. Everything I showed you post-dates those first tests that happened in the early 70s, where they were using data through the mid-60s. And if we think of developed markets not as an independent test, you find similar stuff going on there. But again, I don't want to dwell on this too long. I'll give you a little bit of a spiel about kind of what I think might be behind this. There's a variety of things people have proposed. I've proposed some of them. But really, I'm saying that even though it could be misspecification of risk, I think there's a reasonable argument to say, this pricing is real and anomalous, rather than just that we got the model wrong. So if this is real, what's going on? Why don't we get the result that we want in terms of within asset classes? I think there's a bunch of different behavioral stories. There's some institutional ones, so you don't have to think about individual behavior necessarily, and retail investors might not be that important in terms of setting prices. But I particularly like these institutional stories, which don't really rely at all on less than fully rational behavior. And in particular, I'm a fan of this one, which is that because a huge amount of the assets that are managed by institutions use tracking error as a measure, right? So I'm asking you to kind of beat some benchmark at a given level of tracking error. And so the moment I give you that contract, I'm going to tend to want to avoid risk of a specific type. And it turns out that it's going to be something that causes you not to want to arbitrage this beta anomaly. In fact, if I take a beta tilt less than 1, it's going to lead to higher tracking error than a beta of 1, right? So low beta looks risky to me if I have a tracking error mandate. And as a result, unless I see there's some big return premium, I'm not going to want to tilt my beta less than 1 under those circumstances. So that, again, it's not going to make it inverted as we've seen in the last 45 years, but it would make it flat at least. There's no incentive to do that. And there's other institutional stories I think about fund flows. When does the money come in? It tends to come in when the market is doing well. When the market is doing well, the higher beta asset managers are going to have what look like good relative returns. And so this is a nice story from the 2002 article. So I'm not going to go into any greater detail. A behavioral story that I like and kind of fits with this narrative of the within versus the across asset class difference is categorization. So it's the idea that, like, the world is complicated. I put things into buckets. Like from the fixed income world, a good analog is like AAA. I'm not going to pay too much attention or as much attention as I should within the AAA boundary, even though I might get kind of investment grade versus sub-investment grade. Those across boundaries I might get right. So categorization kind of says that people tend to look at equities as, it's an equity, so it has a given level of risk without necessarily distinguishing as much as they should. And yet I've shown you that there really is an important difference, almost as large as cash versus stocks in the sense of the beta spread, 0.7 to 1.4 that I can find, but it's going to be within this broader bucket of equities. And just more practically, I don't think, a very simple story is just that investors aren't paying a lot of attention to measuring beta. Part of the reason is just on a stock-by-stock basis, it usually is pretty noisy, even though I can see it in the portfolio. And even though people are using it for risk management purposes, they're probably not using it that often at the stock selection point. So these are reasons why I think you're going to get some risk neglect without really appealing to behavioral stuff. Okay, so again, we can move on and say, look, I'll grant you that this is a possibility. That's kind of all we need to be right now. There's a second piece about, is it an integrated risk anomaly? So again, as M&M doesn't depend on a rational trade-off between risk and return. It just says that there's one pricing kernel, and it prices all assets, whether it's debt or equity. Right, so if we want to think about this graphically, and the reason I started off with those two different sloped lines is because I'm going to kind of use that intuition to spell out what's going on here. And so what I'm drawing first here is maybe equities are kind of being priced a little too flat here in this range between 0.5 and 1.5. But I could think of debt as just an extension of this same pricing curve, very simple function of beta down below here. And that would be a situation where there's no relevance for capital structure, even though there are some puzzles for asset pricing to chew on. It's really, this is what I have in mind. So this would be the one is there's just the same risk, same pricing kernel for both. What I'm thinking of is a situation either where debt is kind of correctly priced, or there's a separate risk anomaly in here within debt, that's going to be in a different location. So we kind of need, this will be very simple to analyze, but really what we need is just for it to be one of these three. In fact, if you think there's a bigger risk anomaly within debt, then we're going to be back to kind of the taxes story where I would really want to go all into the debt market. But if we're sitting in this zone here, we'll get an interior optimum, and certainly we will there. So the question is, how reasonable is that assumption? Well, I'm just going to do that kind of graphically. And basically what we're asking is whether in the full history, where I had these two lines, or in the shorter history, where I had the kind of inversion, or the longer history, what we're asking is debt kind of located on an extension of how beta is priced within the equity market? Or is there a gap between where we would predict it, given the relatively low betas of corporate debt, and what we're actually seeing in terms of returns? So we're asking if this thing lies below the line, then that's going to lead to the kind of interesting conclusions that I'll draw. And empirically, what we can do, you can see, of course, the point estimate lies below the line. We can ask, how robust is this? And you can bootstrap this in various ways to try to figure out what the standard error might be on this gap here. And the very short answer is that it looks like it's statistically below the line. There's a little bit of subtlety to it in the sense that corporate debt actually, just on a simple one-factor market model, has a pretty sizable alpha 2. And a fair amount of that is the term premium that we know about coming from government bonds, not so much the corporate bond piece. If it was floating rate corporate, it probably would look like it was much more on the line. And if we add an extra bond market factor, it just kind of make all of this go through very robustly in terms of saying that the beta risk that exists, or the beta pricing that exists within the equity market, doesn't look like it extends over to the debt market in an integrated fashion. Okay, so those are the two assumptions. And then the question is, what are the conclusions? And even though I came here with my timer, I have no idea how much time I've taken. But I will just charge ahead, and if you get very hungry, you can storm out of the room. So take these two assumptions and say, where can we go with them? And I'll do this in two parts. One is kind of sketching out a very simple set of equations, and then the other is thinking about anecdotally, how's this going to play with actual companies. And so again, in terms of just simple math here, writing these down, I've been saying a risk anomaly here means this gamma is going to be less than 0. That's going to give us too flat a security market line. And then debt and equity need to be segmented. That's the second part. So this would be the one where debt is correctly priced. But you could also imagine another one where debt also has a low risk anomaly. And we'll get solutions that aren't at a corner as long as this is going to be lower than that up there. Even if it is at a corner, I think all this says is that firms are really going to want to lever up. It's probably going to be other things like cost of financial distress that would lead them not to go all the way. I don't like that quite as much because I think it's kind of interesting to think about the higher risk firms and why they aren't choosing to lever, and this will provide an explanation for that. So we think then about these, again, I just showed you the equation for, what do I have here? I have the equation for equity, the equation for debt. Well, now the firm, this is a very simple world where the firm, does nothing in terms of adding value, and it's just going to basically going to try to minimize its cost of capital to maximize firm value, right? So they're going to raise some debt and some equity, and they're going to do it in proportions that minimize the cost of capital. Of course, they're going to do something with that, and hopefully it's great, but I don't care about it. So we've got this weighted average cost of capital, some ratio of equity, some ratio of debt. And if we just put in those equations, and I've just kind of left the debt beta as kind of the interesting feature of this model. This whole piece here this is the CAPM. The second thing says, if I have high-risk assets, that's great for me. I'm going to have a lower overall weighted average cost of capital. But at least if I can't directly choose the asset beta, you could have a separate story about how I'm going to choose my asset beta, perhaps. But here we're just focused on capital structure. I can't control any of this. What I can control is I can make this whole term over here as small as possible, or minus gamma times all of this, as small as possible to reduce the weighted average cost of capital. And what that's going to depend on, I think somewhat intuitively, is how much the risk moves into debt. If debt is risk-free, then I want to shift as much risk into equity as possible by levering up. But the moment it starts becoming risky, then I'm going to kind of pay a penalty. And this kind of trade-off that I get in terms of the first-order condition is going to lead to what I think are pretty general conclusions, although their generality is going to depend on what exactly the functional form of the debt beta is. But one is that, this is the least interesting one, is that actually all I need, because I don't have any other frictions in here, is the existence of a risk anomaly. So it doesn't even have to be that flat to get some of these results. Of course, I think this is somewhat of a technicality. There's going to be other costs involved. The second one is that firms will issue as much risk-free debt as they can. Right? And that's because I'm going to end up with risk-free debt just making my equity riskier and lowering its risk-adjusted cost. There's no reason not to do that. But I would say that the relatively few firms, even the first dollar is going to be risk-free. So that's going to kind of give us something interesting for higher risk firms. And then the optimal level of capital, there's really only one parameter in here, and it's the asset risk. And what we'll get is that the leverage ratio is going to be decreasing in asset risk, or the ratio of equity, the way I've expressed it here, is going to be increasing in asset risk. And there's going to be an optimal policy that looks like a trade-off. You could think about this transfer of risk into debt kind of as managing a credit rating maybe. What limits you is that your creditors actually start to charge for the risk that you're putting on them, and eventually that leads you to no longer want to increase your leverage despite this mispricing. Okay, I really love this animation that I have, but I'm not going to do it. I'm sorry, it's disappointing for me. But it basically gets at this idea that eventually, as I shift from debt to equity, you know what? I'm going to do the animation just because I love it so much. Sorry, no dinner for you. Where is this? Can I actually get to this? Maybe not. That could answer my question. Oh, there we go. All right. So basically, again, it's using this idea that there are these two different sloped lines. Debt is going to be kind of correctly priced in this example, and then we have the risk anomaly within equities. And imagine a firm that starts off with just kind of beta 1 asset risk. Okay, and initially they say, hey, let's put zero debt on this firm. And so they're going to have some equity, which has a beta of 1, because the asset beta is going to be equal to the equity beta. And then they have some debt, which has zero beta. It's risk-free initially. And if we think that they can issue some risk-free debt, well, they're going to be issuing debt here, and they're going to be moving out this line over here as they make their equity move from 1 to 1.2 and so on. So their initial cost of capital is there, and they're actually able to lower it. They're just shifting out here, and they're issuing risk-free debt. So why don't they just keep going, lowering the cost of capital? Well, eventually, we start to move some risk over here into debt, and it's no longer intersecting at a zero beta. There's actually some risk, and it's actually going to start increasing as I go back up. And of course, at the limit, I wouldn't want to go necessarily to 100% debt, because that's just going to get me back to kind of fair pricing beta 1 debt. And I'm kind of back here at the beginning. And if I put all of that together, I kind of get this interior optimum there, where the cost of capital for a beta 1 firm is going to be minimized kind of in the middle here. So I know you really enjoyed that animation. Now I can't get back, sorry. There we go. Okay, so what does that mean? I need to have some functional form for the way risk gets shifted from equity into debt. And if we use something like the Merton model, we're going to get some nice looking curves. This was for the beta 1 example that I just showed you. And really what's going to matter, again, there's only one parameter, is what if I have really low risk assets that I start with or really high risk assets? Well, that's going to lead to some differences here. And in particular, if I have a high beta, I'm going to reach a minimum at a much lower level of leverage than if I start off with a very low beta. I really want to issue a lot of debt before I kind of reach the optimal point. We flip this around. Again, these are simple firms. They maximize firm value just through their financing activities. And these would be a set of firms that would all be worth 10 in terms of, if you think about what their fundamental value is, they're all worth 10. The high-risk firms are kind of overvalued to start with. The low-risk firms are undervalued. But they're able to kind of boost their value through their financial transactions of raising debt versus equity. And they reach optimums that kind of are going to change as you get to lower and lower risk. You get to higher and higher leverage. Of course, back here at 100% debt, they're all fundamentally valued correctly, again, because the debt market, at least by assumption here, is efficient. Again, we don't need to have the debt market be perfect in that sense, but it makes things very simple in terms of the analysis. So we think about some examples and getting into what the implications are. You can think about a high leverage puzzle here. And again, this is not as famous as the low leverage puzzle, but a high leverage puzzle would be a firm that has no tax benefits and nonetheless levers up a lot. And these are maybe less puzzling because they're firms that have really good collateral. But again, the reason, if you're mainly worried about financial distress, why not just raise all equity perhaps? And this would be a firm where there's a container leasing company that I know pretty well. This particular one is called Textainer, but they pay no taxes, and for two reasons. One is that because they're a leasing company and that's it, they have very high bonus depreciation. So as long as they're kind of growing moderately, they don't have taxable income because they're depreciating their assets at a very rapid clip. In addition, if you don't, if you think, well, eventually they're going to pay taxes, and they will if global trade slows down, as it has, but even so, they tend to be located in the lowest possible tax jurisdictions because this is a transportation, sort of kind of an addressless company that is mainly operating on the seas. So for a variety of reasons, they pay no taxes, and yet they have very high debt. And then a low leverage puzzle would be like a tech firm like Linear Technology that I happen to write a case about. They have zero debt, excess cash, even though I'm quite sure that they're paying taxes at a pretty high rate. And again, relying on John Graham, but also looking at the financials here of Linear. So what's going on there? Again, it could be collateral, a variety of different stories. So I'm just going to again, gloss over that. Not that those aren't equally important, but just to make it simple in terms of what mechanism might be going on in addition, is if I think about this firm like Textainer, which has quite low-risk assets. These containers move around a little, their value moves around a bit, but it's not hugely volatile. And so if they started off initially with zero debt, they're just going to do a simple calculation. They say, my equity's undervalued. I did a DCF, and I'm coming up, maybe I even use the CAPM, and I'm coming up with the fact that my equity is undervalued. And so what I'm going to do is I'm going to replace some of that with debt. And that does two good things. One is it does this nice swap of something. I reduce this thing that's undervalued, and I increase this thing that is fairly valued. And from a cost of capital sense, I like that. In addition, I make the remaining equity riskier. So you kind of saw that in the graph. And for Linear, it's just the opposite. This is a firm that starts off with pretty high-risk assets, even at zero debt. And as a result, this kind of debt for equity swap doesn't look like such a good transaction to them just on a simple valuation. Even though they could maybe get a little bit of juice by levering up their equity, it's not so clear to me that managers talk about this second mechanism. And in any case, it's going to kind of die out pretty quickly because they can't issue that much debt without it starting to absorb the risk, importantly. Okay, so I'm just going to go through, I think, a couple of applications here, which are going to be of the hand-waving nature to get us to food. Is I kind of talked about the corporate leverage piece, and you can think about, we can do all of this kind of with this structure of what maximizes firm value for firms of different initial risk. And so we kind of talked about Textainer there. they might be kind of a asset beta of 0.5, and so they might reach a maximum up here, in 70 to 80%. And then linear is over here. While they might want to issue a little bit of debt if there's kind of cost to accessing the debt market, or maybe the Merton model. The Merton model has a feature that it always looks like it can issue a little bit of risk-free debt. That might not be literally true. So they're going to be over here at very low leverage. And then if we want to think about other things going beyond that to private equity, I'd maybe put private equity in the category of looking for publicly traded stock that can be levered up, that's relatively low risk. So I see it's undervalued, and I take this firm that really isn't levered appropriately, I buy it, it's kind of a Textainer type company, I lever it up. And while, look, private equity may be doing many other good things or not, I don't know, they might be improving the operations of the firm. This is just a tailwind that might exist for private equity investment, is they're going to take relatively low beta assets, lever them up so that they have a high beta. I'll say as an aside, if you just think about how private equity investors think about their cost of equity, you very frequently hear, well, we target an IRR of, call it 15 or 20 or 25%. Very rarely will they use okay, but what about the risk? You use a different one for depending on what the risk level is. They tend to say no. And this is exactly, it's kind of saying that their cost of equity is relatively insensitive to risk. And that's kind of the point here, is that when you face a situation like that, whether it's explicitly because a private equity firm has that contract with its LPs, or whether it's the equity market that has too flat a security market line, you'll get to this situation where you're going to tend to lever things up so that the equity is always reasonably risky. How do I get my 15% or 20% IRR? Well, if I'm investing in low-risk assets, I'm going to have to do it through leverage. Thinking about venture capital, maybe that's more in the line of saying these are firms that are going to tend to be, on average, be highly valued in the public markets, and if there is an active market for those firms, I'm going to find them at, say, my fundamental value of 10, and then I'm going to do this arbitrage of the fundamental value, which I am then going to take public at a higher price, because these are kind of initially high-risk assets. And I might even be willing, if I have competition within that market or competition within private equity, a lot of this benefit may accrue to the entrepreneur, not the venture capitalist, or to the management of the low-risk firm, not necessarily the private equity LPs. But you get the idea that there's going to be an incentive to do these kinds of transactions. And then bank capital is, Jeff and I have a separate paper on this, where we kind of initially started on this idea. And I think is a useful way of thinking about banks' resistance to substantially increased capital requirements. And I'm not saying that capital requirements shouldn't be a lot higher, but it's kind of taking seriously the argument that bankers say is look, if I have to hold 30% equity, my overall cost of capital is going to rise, and for reasons that aren't just about taxes. So the argument sort of comes directly out of this story in the sense that they say, look, my cost of equity is 12%, and we respond and we say, look, if you raise a lot more equity, it won't be 12, it'll be 6. And we say, no, it's still 12. Right? That's kind of, again, the risk insensitivity that doesn't make sense from kind of a textbook finance 101 sense, but if there is this differential pricing of risk, it just becomes costly to raise equity to finance what are effectively fixed income assets. So here this would be a very low risk assets. Again, banks were risky, but on a leverage basis. If I start off with very low risk assets, I'm going to want to be way out here. And if you push me down to a much higher capital, extremely heightened capital requirements, I'm going to look like I'm at a disadvantage relative to other forms of capital. So that's basically the story. I would put it again in the original terms as there are kind of two facts you already knew. There's this steep across asset class equity risk premium and the flat security market line, recent history, long-term history, both with this big differential. And it, of course, could be misspecification. And this is taking seriously the idea that this is a mispricing of risk, that it's not being priced consistently across these two asset classes. And if you take that second point of view, then there's a simple idea that we get to a risk anomaly trade-off of leverage. And I have had trouble sort of finding like what's going to be the killer empirical test that's going to say it's this as opposed to something else. But I think it is consistent with a wide range of different facts with a relatively simple model, and also incorporates the asset pricing evidence at the same time. So it's one I think that's relatively easy to square with what CFOs and bankers and private equity investors say when you dig in on this issue of the risk sensitivity of equity. So that's it. Thank you very much.